Welcome to our channel. Today, we are diving into the massive megabill signed into law by President Trump on July 4th. This sweeping tax and spending bill represents a major step forward in fulfilling key campaign promises he made. One of the central elements of this new law is the extension of existing federal income tax rates and other provisions from the Tax Cuts and Jobs Act, or TCJA, which were otherwise set to expire at the end of this year. This ensures continuity for many taxpayers. Mark Luscombe, a CPA and principal analyst for Wolters Kluwer Tax and Accounting in Chicago, notes that from a tax point of view, most everyone should benefit. This is mainly due to the extension of those TCJA provisions. Under the original TCJA, most taxpayers saw lower tax rates, an increased child tax credit, and a bigger standard deduction. Luscombe states that making these things basically permanent and increasing the child tax credit will tend to lower taxes for most everyone, unless they already pay no income taxes. However, Luscombe emphasizes that his assessment is solely from a tax perspective. This law is truly massive, encompassing a slew of domestic policy provisions beyond its myriad tax law changes. For instance, the law includes an estimated $150 billion for a crackdown on immigration and new restrictions on Medicaid and other social support programs. Studies have shown that lower-income Americans could suffer even as wealthier people enjoy valuable new tax cuts. An analysis by the Budget Lab at Yale, a nonpartisan policy research center, revealed stark differences. Americans in the lowest 20% by income are projected to lose an average of $560 per year. Meanwhile, those in the highest 20% could see an average gain of $6,055. Let us delve into some of the key tax provisions within this new law. Many of these tax benefits take effect for the current tax year, 2025, and are set to end 4 years later, at the close of Trump's term. A significant change is the much-debated increase to the existing $10,000 cap on the state and local taxes, or SALT, deduction. This deduction generally benefits wealthier taxpayers in high-tax states. The cap on the SALT deduction will now be $40,000 from 2025 through 2030. It will phase out for taxpayers with modified adjusted gross income of $500,000 or more. The value of the deduction and the income limit will also increase by 1% per year until 2030. After 2030, the cap drops back to $10,000, which is the current cap put in place by the Tax Cuts and Jobs Act of 2017. So, it is a temporary boost. The law also introduces a permanent increase to the child tax credit. It rises to $2,200, up from its current $2,000 starting in 2025. This amount will adjust for inflation each year after 2025. Without this law, the child tax credit would have dropped significantly to its pre-TCJA level of $1,000. This permanent increase provides substantial relief for families. Making good on Trump's campaign promises, the law introduces new tax breaks for qualified tip income and overtime pay. These are specific benefits aimed at certain income types. Income tax on some tips is eliminated, starting in 2025 and continuing through 2028. The law includes a new tax deduction for up to $25,000 in tip income. This tax break begins to phase out at modified adjusted gross income above $300,000 for married filers, or $150,000 for all other filers. Similarly, income tax on some overtime pay is eliminated, also from 2025 through 2028. There's a cap on this no tax on overtime pay benefit. That cap is $25,000 of overtime pay for married filing jointly filers, and $12,500 for all other filers. The tax perk for overtime starts to phase out at the same income limits as the no tax on tips provision. This means $300,000 for married filing jointly and $150,000 for others. Another notable provision is a temporary bonus. Standard deduction of $6,000 for Americans 65 and older. This is in addition to their current standard deduction and the existing extra standard deduction they already receive. This bonus applies for tax years 2025 through 2028. This bonus standard deduction amount would phase out for single filers with modified adjusted gross income of $75,000 or more. For married couples, it phases out at income of $150,000 or more. A brand new feature of this law is the creation of a tax-deferred savings account for children, dubbed Trump accounts. These accounts can be opened for children aged 8 or under. Contributions of up to $5,000 per year are allowed, with some exceptions until the child reaches 18. Any distributions used for qualified expenses, such as certain education costs, small business expenses, and first-time homebuyer costs, will be taxed at long-term capital gains rates. These rates are generally lower than ordinary income tax rates. Non-qualified distributions from these accounts will face income taxes and a 10% penalty. As an added bonus for U.S. citizens born from 2025 through 2028, these accounts will receive an initial $1,000 from the federal government. The law also makes the TCJA's higher estate tax exemption permanent. This means a $15 million estate tax exemption per individual, or $30 million for married couples, is now permanent. This exemption also includes a built-in inflation adjustment. The popular qualified business income deduction is also made permanent by this law. Its value remains at its current 20% of qualified income. However, a minimum deduction worth $400 is added. This deduction is for pass-through entities like S corporations, partnerships, and sole proprietorships. For those who do not itemize their deductions, a new tax deduction for car loan interest is created. This is available from 2025 through 2028. The deduction is limited to $10,000 of car loan interest. It phases out for single filers with income of $100,000 or more, and for couples with income of $200,000 or more. Furthermore, a deduction allowing non-itemizers to claim charitable contributions will go into effect in 2026. This deduction will be worth up to $1,000 or $2,000 per married couple and will be permanent. A major piece of this new law is maintaining the status quo with regard to current tax law. Many key changes made by the 2017 TCJA to individual tax laws were set to expire at the end of 2025. These TCJA changes included the near doubling of the standard deduction and increasing the child tax credit to $2,000 from $1,000. The top tax rate for high-income earners was reduced to 37% from 39.6%. A new 20% deduction for certain types of business income was also created. This new tax law ensures that many of these important tax provisions stay in place. However, lawmakers did make some subtle tweaks around the edges. The new law adds an extra boost to the standard deduction for 2025. For single filers, the standard deduction is boosted to $15,750, an increase from $15,000 before the law. For head of household filers, it goes to $23,625, up from $22,500. Lastly, for married filing jointly filers, the deduction increases to $31,500 from $30,000. The law also adds an extra inflation boost for some tax brackets for 2025. Specifically, it offers a one-time increase to the annual inflation adjustment for the 10%, 12%, and 22% brackets. This effectively reduces tax rates for many. Despite some benefits, this new tax law will lead to drastically different results for U.S. taxpayers, depending on where they fall on the income spectrum. The wealthy are projected to see their income grow, while the lowest income Americans could experience sharp cuts. According to a CBO report covering 2026 to 2034, wealthier taxpayers, those in the top 10% of income, would enjoy a 2.3% boost in resources or an extra $12,000 per year on average. Middle-income taxpayers would see their resources rise, but by less than 1% of their income. This is an estimated extra $500 to $1,000 per year on average. In stark contrast, taxpayers in the lowest 10% of earners would see their resources drop by about 3.9% of their income. This translates to about $1,600 per year on average. It is important to note the CBO report is based on a House version of the legislation, which is slightly different from the bill that became law. Finally, the new law also ends some existing popular programs. The popular Direct File program, an online free guided tool that allowed taxpayers to file their taxes directly with the IRS, is eliminated. Additionally, electric vehicle tax credits are killed as of September 30th. This new megabill certainly brings a mix of changes, from extensions of popular tax cuts to new benefits, alongside shifts in domestic policy and varying impacts across income levels. Understanding these details is crucial for every American taxpayer. Thank you for watching. If you found this information helpful, please consider supporting our work. Your contributions help us continue to provide in-depth analysis and clear explanations of complex financial topics. We appreciate any support you can offer to keep our content freely available.